VOO has crushed SCHD by 17% over the last 3 years, but I think SCHD is poised for a comeback. In this video, I'll take you through 3 reasons why. This is Kyle with Fundamentals of Finance. I run this channel with Ethan, who's a CFA Charterholder and investment professional, and this channel is dedicated to helping people become better investors. Just to level set, VOO is an S&P 500 ETF from Vanguard, but this analysis applies to all S&P 500 ETFs and index funds. And SCHD is a high-quality U.S. dividend ETF from Schwab, but this applies broadly to most U.S. stock dividend funds. Let's start with reason number 1, valuations, starting with the Buffett indicator. The Buffett indicator is the total market cap, aka the size of the U.S. economy. Even after the recent sell-off, this remains in significantly overvalued territory and implies a 1.9% return on stocks from here. There are 3 components of total return on U.S. stocks: earnings growth, valuations, and dividends. What this indicator is saying is that valuations are likely to come down and earnings might be lower than expected, both of which are pretty likely if we continue with the constant flip-flopping on trade policy, because not many businesses will want to make big multi-year investments in that environment. Uncertainty is not good for stocks, and the level of uncertainty is very high right now, but valuations still don't reflect that. So then where would that return come from? Dividends. When the market is going up 25% per year like it did in 2023 and 2024, those little 2, 3, or 4% dividends don't seem that important. But if the market is going down in an uncertain environment, the reliability of the dividend component of return becomes a lot more valuable. And right now, high dividend paying stocks are about as cheap compared to low dividend paying stocks as they've been at any point in the last 40 years. So why is that? Mainly, it's because of the bubble in growth, AI, tech, and the Mag 7, all of which have been the key drivers of the S&P 500. Just take a second to think about how crazy that is. The S&P 500 is 500 of the largest stocks in the country, and 1/3 of the index is in just 8 stocks, and all of them are tied to tech and AI in one way or another. We did a whole video about why I believed AI was a bubble in August 2024, and it's now popping. Just in the last month, we've had Microsoft canceling billions of dollars of data center projects. Even if it's not a bubble, I still think there could be an adjustment period that would lead to a painful reset of expectations for tech and AI investments, including those at the top of the S&P. That would be consistent with basically every other major technological advancement we've ever had. You see, in the early stages, it's the enablers of the technology that do well. Think AOL and Cisco systems in the tech bubble. AOL provided the internet, Cisco made things like modems and routers to make the internet work. Then there were all the telecom companies laying down fiber optic cables, most of which ended up going bust because they built up way more capacity than ended up actually being used. And now, just a few weeks ago, the chairman of Alibaba, one of the biggest tech companies in the world, warned about the same sort of bubble in US AI investments. Traditionally, in the short run, the enablers of the technology like Nvidia and Google are the winners, but in the long run, it's the users of the technology that are the winners. In the internet era, that was companies like Netflix, Amazon, and Meta, which couldn't have existed without the internet. For AI, we don't know. Some companies like Google in the internet era can be winners in the early and later stages if they adapt, but some of the biggest winners of the last few years will likely not be the biggest winners over the next 10 years. This is how it's always been. In 1980, 6 of the top 8 companies were oil companies, and 9 of the top 10 were in the US. By 1990, only 2 of the top 10 were still in the top 10, and 8 of the top 10 were then Japanese companies. By 2000, only 2 were Japanese companies, and 7 out of 10 were internet related. By 2010, only 2 were internet related, and 7 out of 10 were outside the US. By 2020, it was all about the internet and the US again, with 8 out of 10 in the US and 7 out of 10 internet related. On average, only 2 of the top 10 stocks have remained in the top 10 a decade later. And where are we today? 9 out of the top 10 are internet, tech, or AI related. So what does that tell you about the next 10 years? Maybe it might not be best to put all your eggs in that basket. And if you think the S&P 500 is diversified, well, then let me remind you, it's the least diversified that it's ever been. And that brings us to our final reason that I think SCHD and dividend payers will beat VOO and other growth-oriented tech-heavy investments over the next 3 years and probably also 5 and 10. In periods of higher interest rates, they generally have. As rates rose in the 1970s, it was high dividend-paying commodity stocks like oil and mining companies that did the best. Then in the 90s, rates came down and tech rallied. Through the mid-2000s, dividend payers and commodities dominated again. Then in the last decade or so, rates have fallen and it's been all about tech. Obviously, interest rates are not the only driver, but they do contribute. High growth investments usually require a long time horizon, and if you have to borrow for a long time, the rate on your interest makes a big difference. That's the very basic underlying concept behind why higher interest rates hurt growth companies more than value companies. The last couple years, most people have been expecting inflation and interest rates to come back down, but now I think the market is not so sure. Trump is trying to get permanent tax cuts passed, which would significantly increase the country's long-term debt, all while picking fights with the entire world, making huge threats, changing his mind constantly, and reducing the world's confidence in U.S. assets. More borrowing and less demand for U.S. debt means higher interest rates. He may want them to come down, but his actions are causing them to rise and potentially stay higher for the foreseeable future. If that happens, this valuation gap between high and low dividend payers could close a lot further, meaning dividend-paying stocks like those in SCHD beat more growth-oriented stocks like those that dominate VOO and other S&P 500 trackers. Last thing here, if you found this video helpful, hit that like button and also please hit that subscribe button. We also have a free Discord with over 450 members. The link to that is in the description below. Thanks for watching, and we'll see you in the next video.